Sup guys, Christos here. In today's video, I'm going to be sharing with you my top 4 growth stocks that are all currently worth under $50 at the time of recording this video. Some of the companies I'm going to be talking about today are companies I'm currently invested into myself, and some of them are going to be stocks that I'm closely watching and I may start buying in the near future. Either way, this video is very much opinion based and you should always do your own research before investing your own money. But having said all that, let's jump straight into it. Alright, so first up on the list we have DraftKings. Now, this is a stock that I have been watching for maybe a couple of months now since actually signing up to the service myself back around late August time. And basically, DraftKings, if you didn't know already, is a fantasy sports betting website where you can essentially win money based on betting on different players' individual performances. They do also offer the original forms of gambling like the sportsbook and the DraftKings casino, but in my opinion, the service that really helps them stand out is their fantasy football daily competitions. But more on all of that in a second. In terms of its stock price right now, it's currently trading at $49.82, making it just qualify for this video. But what's rather interesting, as you can see here, is that in the past month, the stock has actually dropped around 15.5%, making this stock, according to some analysts, as 43.8% undervalued. Now, in terms of why this company has dropped so much, since following it, I haven't really been able to put my finger on a single cause other than just a general market sell-off that we have had over the past month. And when you usually do get a market-wide sell-off, it's normally the higher growth stocks like DraftKings and some of the others that I'll be mentioning in this video that see the most volatile movements. Some quick fire fundamental things I really like about this stock. Number one, I absolutely love the product. It's a product that I currently use myself right now. And with its fantasy football betting, I really do think it separates itself from the traditional betting websites that are out there at the moment for now. Number two, just like what we look for in any solid growth stock, it's had some really strong revenue growth as of late. For example, they generated $298 million in Q2 of this year, which is growth of 297% year on year of this time last year. A lot of this is going to be relating to the new sign-up increase of roughly the same of 281%, and the average spending of each player per month has actually increased to $80, which is a rise of 26%. So just to break this down, more people are signing up to the DraftKings website. From there, they are spending more money on a monthly basis, which then eventually funnels down to the company generating more revenue as a whole. Now, the third thing that I really like about this company is to do with the industry that it's in, and that is sports gambling. And sports gambling is still a big industry on the rise. One thing some people may not know, especially the English viewers of this channel, is that gambling in America has actually been illegal for most states for quite some time now. Obviously, Nevada and Las Vegas somehow got away with that. But what is starting to happen right now is that just like marijuana stocks, gambling is now starting to become legalized again, which is only good news for the sports betting industry. And with the brand recognition that DraftKings already has, I can see this company being the forefront and grabbing a large percentage of that market share. So stock number one is going to be DraftKings, and this is an exclusive on this channel. This is the first time that I think I've mentioned it. I'm most likely going to go a lot more deeper into this company on a video coming very soon, especially if I do go ahead and buy this stock. But if you do want to see that video, make sure you do let me know in the comment section down below and I will get that out sooner rather than later. But stock number one, DraftKings. Now, the next stock up on the list is going to be one that I'm just going to get out of the way, because if you've watched my stuff before, you'll already know my feelings on this company, and that is Corsair. However, just a quick breakdown for those that don't know what Corsair is. It's a computer peripherals company that focuses on products like keyboards, headsets, monitors, and computer parts. Its stock price is currently trading at around $26, and just like DraftKings, this is another stock that has been absolutely battered over the past month, with the share price dropping around 10%. Just to gloss over some of the main reasons why I think this stock is a great buy right now. Number one, once again, a great company and a leading brand in its sector. Number two, a ridiculously oversold stock given the results it's been posting over the past year. One thing I really like about what they have done is not only they have seen positive revenue growth this year, they are now actually starting to turn a profit. And I think a lot lot of this has come down to them taking this newfound growth and using to improve its balance sheet as a whole. One of my early concerns about this company, as you can see here, was its high debt to equity ratio. But as you can see throughout the year of 2021, they have now lowered their debt to equity ratio from around 205% to 51% in the single space of a year. Now, the third thing that I really like about Corsair stock is very much like the industry DraftKings is leading. Corsair is in a market that is only going to keep growing over time. Every year, more and more people are converting from consoles to PC gaming. More people are starting up YouTube and Twitch channels that require streaming equipment. And with the debut of their first ever gaming monitor, this once again opens up a brand new revenue stream in an ever growing industry. Now, I've only really scratched the surface here talking about this stock. So what I am going to do is leave a video up here, which is actually a video I made around a week ago, which is talking about why I think Corsair stock is going to double within the next 12 months. So feel free to go and check that out. Okay, so stock number 3 is actually a completely brand new stock that I've actually only started to look into this week, in fact. So I haven't actually done my full research into it yet right now, but that stock is going to be Chargepoint Holdings. Now, what Chargepoint Holdings is very self-explanatory. Essentially, it's a company that provides electric vehicle charging networks and solutions across the United States. Currently, right now, the stock sits at $20 and this company, out of all the different ones that I've shared in this video, has been battered the most, with the stock actually being down roughly 45% year to date. Now, from what it looks like after doing a little bit of research, what has actually happened here to cause this was a couple of things coming all together at the same time. Firstly, in July, the company announced a secondary public stock offering of 12 million shares where certain stockholders could actually grab the shares at $23.50. Now, with the company starting off July at a price of roughly $35, this was always going to see a pullback in the stock price. And then secondly, another reason why I think it started to continue dropping roughly a month later was some disappointing results from the recent US infrastructure bill, where basically the government announced funding for new EV charging stations that were considerably lower than the amounts investors were expecting. However, I think one thing that we cannot ignore is that despite these setbacks early on for the stock, this is going to be a big one for the future. Now, like I said, I haven't looked too much into this company, but a couple of real basic things I'm really excited about is, number one, electric vehicles are the future. We can't get away from the fact with that one. And with ChargePoint currently being the largest charging network across the United States, and with the demand for more chargers to obviously continue throughout the next coming years, this is likely going to continue to rise and put more pressure onto the government for fundings for things like this. The second thing, just taking a bird's eye look here at the balance sheet, everything looks really solid. Both short-term and long-term assets outweigh their liabilities, and the company is now in fact 100% debt-free as of August the 30th this year. My birthday, by the way, put it in your calendars. And then finally, another thing that I really like is that it's actually made 2 recent big acquisitions in companies that are actually going to help its expansion outside of America into Europe. First up, what we have is a European company called Has2B, which is also an EV charging company with roughly 40,000 network ports. And then the second one we have is Very City, I think it's called, which is basically a fleet management software with roughly 2,500 ports. Now, I'll be honest, like I said, I haven't looked into all of this enough to really think about making an investment yet, but this is a company within a disruptive sector that is going to see substantial growth over the next 10 to 20 years. So of course, do your own research into this like I'm going to be, but I had to include it in this list as I definitely feel it qualifies as a stock that has high growth potential that's under $50. All right, so stock number 4 on the list is going to be a company that I've been investing into very much since the beginning of the year, but one that I haven't made too much content about on this channel recently, and that is going to be Tattoo Chef. Now, for those that didn't know what this company does, no, it isn't a tattoo chef that comes and cooks for you. Instead, it's a plant-based food company that offers quick and easy solutions to healthy eating. Currently, the stock price for this company sits at around $18 roughly, and by looking at this chart right here, it's been a pretty rocky year for this stock. Just taking a look at this, as you can see, it's spent most of the year rotating between roughly roughly $17 and $24, which actually makes it look like a great stock to potentially swing trade. But I really do like this stock from a long-term investment point of view. I actually first heard about this company, like most did, watching Jeremy over at Financial Education, and then after months of research I finally started to build a solid bull case of my own for this company. The first and most obvious thing as to why I think this company has a great future potential is that, number one, it looks like the whole eating healthy and the going vegan trend is here to stay, and whilst there are already many great plant-based businesses out there disrupting the food market, I really like the different approach that TTCF has actually taken. As a busy entrepreneur myself, for me, eating healthy without spending hours prepping my meals can sometimes actually be a challenge. I normally can keep up for it for about a week or so, but when I get rushed, it normally leads to me grabbing a quick ready meal out of the freezer and then boom, I go back into a world of high saturated fat foods. But TTCF actually solves that issue for me. Now, the second reason why I like this company is that whilst the last earnings results back in July, August time, I can't exactly remember the date, didn't provide the best earnings growth, with them actually underperforming expectations, I'm still confident this is going to be a rapid growing food company over the next 5 years. For example, it's only been this year where they are actually starting to get some big allocations into some of the major supermarkets in the United States. We now see Tattoo Chef's products in Kroger, we now see them in Sam's Club, we see them in Target, and now we have recently been announced that we're going to be starting to see them in Publix as well. And I just simply think that these results are actually going to take some time to actually come through, and I just don't think that as investors we've seen the full effect of these expansions yet. Another thing I really like are some of the basic financials of this company. Unlike Corsair, which is of course going to be a high cost business to run, TTCF's debt to equity ratio is actually very low, sitting at 2.2%, and once again, just like Chargepoint, it's both short-term and long-term assets outweigh their liabilities. But all in all, I think that TTCF is going to be a really good company for the future. I do think it's going to be one that you're going to have to be patient on, and I do think that this trade, swing trading of it going from $17 to 20, mid-20s and then dropping again, is probably going to be going on for quite some time now, but that is also a really good opportunity to buy this stock up at a cheaper price. But all in all, TTCF is definitely going to be one that I'm going to be holding on for the long term, because I think it's going to bring some really high growth. And that is simply my top 4 growth stocks that are currently priced under $50. Now, if you are investing into any of these companies, I would love to hear your thoughts about them in the comment section down below. Another thing is, if you haven't joined my free investing Discord group, then make sure you go and check that out. The link for that will be in the description down below. Every single one of these companies are going to have their own individual channels that we can chat about further in there. But having said all that, I'll catch you guys in the next one. Take care, and I'll see you soon.